Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman and Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.
Hello, my name is Michael Stoller. I think it was like January 11th or January 12th, 2002, from a restaurant that's now called Solo, at that time called Shallot's, live from Shallot's Kosher Restaurant. It was the Stoller Report on radio. And I had 4 guests, but one were not here. And at that time, I had these individuals who are with me again today. So we'll introduce them and we'll talk about the time. My guest today includes Stephen Siegel, the chairman of global brokerage at C.B. Richard Ellis, Jim Kuhn, the president of Newmark Knight Frank, and Bruce Mosler, the president and CEO of Cushman & Wakefield. They all have the same job, the same looks, gray hair, but what has gone on? How do you look at 2002 when we had just come after 9/11, a couple of months? There was unbelievable amount of vacancy. The city was in turmoil. How are we now in May of 2009, Mr. Siegel?
Well, first of all, I thought this was the 10th anniversary.
It is. It's not the 10th.
No, I know. Obviously, I can count.
I'm not sure
the
about
7.
that.
No, I can count the 7.
It's really our 8th.
First of all, 2002 and this year were not even close to being related. 2002, we had a excess of sublet space. We had perhaps the perception that we wouldn't recover from 9/11. It's $20 billion of lost revenue downtown, but we could see the light at the end of the tunnel. We didn't have 5 or 6 investment banks basically disappear. Other banks in serious trouble. The amount of unemployment that exists on a national basis, we weren't living with a recession of anything remotely resembling this. We were dealing with a specific problem in New York.
Jim?
Well, Warren Buffett has a saying that I love. He says, be fearful when others are greedy, and be greedy when others are fearful. And I think the difference between 2002 and today is that was purely fear, and this is systemic. I think even in the early 90s, it wasn't as bad as today because the ability to come out of the recession was easier because when Bill Seidman ran the RTC, he had a concept called bridge banks. Took them over on Friday, got rid of the bondholders, got rid of the stockholders, put new management, came back on Monday, depositors were fine, no mark to market to deal with, took back all the assets, and they regenerated the credit engine. We're not doing that today, and it's going to take a lot longer because we didn't take the pain early enough.
Mr. Ultimate Optimist?
Well, I feel I have an obligation to be somewhat optimistic after my partners. But look, I think that Steve and Jimmy have pointed out the facts, and the facts are, as Jimmy just said, this time around we have systemic issues. We've seen the entire investment banking industry go away, with a couple of notable exceptions. And we are seeing systemic issues in the current environment. We're also seeing multi-industry problems. In the past, I think that we have seen recessions that have been industry related, but not necessarily across the board systemically bad. So the dynamics are very different. But I think in the last 6 weeks, we are beginning to see some light at the end of the tunnel. I think some panic and fear has come off. I think you have to also bifurcate the issues. The issues today that I see that challenge this country go beyond just our economy. In foreign relations, I think we have a president that's reaching out that today is respected, is looked up to, and I think is going to make a huge difference in terms of the global picture. And we are in a global economic downturn. I also think that domestically, that banks are working their way through this crisis. Now, we will see what the stress tests produce, but I have some optimism about what those results will produce, and I think we have seen...
Did Wendy give you happy pills today?
No, not happy pills.
I have one question.
I can't.
We're not supposed to talk politics, but do you have a different president than I do?
Maybe, but I think the point that the reason I bring this up and talk about this is because this is not a U.S. issue. This is a global economic downturn. And therefore, we'll work our way through this.
We'll work our way. I was telling Jim last week, I was at a think tank meeting with about 25 people from around the country, and we had a person who's with the IMF, who used to be with the FDIC, another person who was with the RTC, someone with the Heritage Foundation, and they basically said, you know, this world is not getting better. We are sitting here with $1.2 trillion of commercial mortgages coming due that no one, in the past, we never had these things called CMBSs, with tranche warfare, with office values going down, with everything, you know. I don't want to be the ultimate negative person, but I think you're incorrect.
Michael, let's talk about the banks for a second, okay? We've had an upward tick in the stock prices of the banks, but the reinterpretation of the FASB rules lately on mark-to-market, which allows banks to book a profit as if they bought their own loans back at a discount, to me, is the first tool that they're using to inflate earnings. Second of all, the stress tests are totally dependent on what economic growth factors the government puts into the equation.
That's true.
I am not bullish yet on most of the banks. I think that there's still a ton of real estate debt. I think that TALF and PIPP is going to be difficult because I don't think the banks are prepared to sell at market prices today and take the market right down. So I think because of these problems in restarting the credit engine, I think we have a ways to go.
I'm not saying we don't have a ways to go. I want to make the following point. In the relaxation of the mark-to-market, Jimmy, I think you're absolutely right. It's going to create a little bit of a false hope in terms of current earnings. However, I'm talking about something different. We have seen a 30% deterioration in market rents. We are going to see, when there's something to benchmark against on the investment sales side, significant cap rate rise. If you still want to use cap rates as the benchmark, and I'd argue that may not be it. But from a replacement cost perspective, you're going to see assets as they come online, and they're not there yet, in my world, be attractive on a comparable basis to what they used to be. There are tenants today in the marketplace looking at the rent deterioration saying, maybe this is the moment. Can't time the absolute bottom, but maybe this is the moment to get back in the market.
So are you saying...
I'm seeing glimmers of hope. I'm not saying by any stretch
but the liquidity
we're
is still
through it
not
or on
there.
the other side. The liquidity issue is a different issue.
Well, to get back in the market, you have to have some liquidity. You have to have some
capital. And I think you're
available
beginning to see
besides
trades
a fund.
occur. Yeah, not just funds.
Okay.
You're beginning to see banks put some money back into the system.
Let's understand. Look at the trades that took place in New York over the last couple of months.
Only a couple.
I mean, but they were all due to seller financing. There was nothing.
Sure.
There was nothing over there. If you want to get a loan in excess of $50 million, you need a club, and now there aren't clubs. I mean, I can unequivocally tell you that...
Let's see what happens Q3, Q4, when prices adjust, when there are assets and portfolios that have to
There is a bank called Citibank who hasn't made a real estate loan in New York in the last year and a half. There are other banks who haven't done anything. There are global debt funds who haven't done anything. Nobody has confidence right now in the New York City marketplace.
I don't think, Michael, I will disagree with you there. I don't think it's a question of confidence in the New York City market. I think it's a question of pricing and inherent risk. My philosophy is that we are now at 2003, 2004 pricing levels. Now,
Agreed.
there are many, many owners of property that in 2003 and 2004 were very happy with the rents, were very happy with the concessions they had to give, and based on where they bought in the upcycle, they made money. Those same landlords today aren't willing to accept pricing that they were happy with in 2003 and 2004. So
What about 1994 when you were
Are
able to buy
they
something?
unwilling to accept, or they
They
leverage
can't. In
their
some
property
instances,
to
they
a
can't.
I think
place?
Steve is saying,
I
which is correct.
I think it's a mix.
Sure.
I think there are some landlords who have leveraged themselves out of the marketplace. And don't forget, the difference between now and the 90s, Michael, is we have multi-tiered lenders with non-aligned interests. And so that you have to wade through the various tiers of mezzanine debt to get down to the senior debt, which may or may not be okay. And that's going to take time. And that's one of the problems that's slowing down the re-engineering of the credit markets.
I mean, all
And
of
in
you.
fact, the benchmarks that we need to
the
establish
three
real
of you
value. So-
represent the largest investment sales in the country. I mean, there's no one. I mean, investment sales were down how much last year?
For us,
Yeah.
probably 50%.
Same.
And what a price is down. If you could figure a comp
Well, New York
from
prices-
2007,
50%.
when the peak hit
40
in
to 50,
2007, are we down 50%?
Even more. Well,
Well,
using
I'd say
Harry as a benchmark?
40 to
or-
50.
Let
But
you
this
know.
is New York. There's also another world out there
Fine,
too,
but
right?
yeah, which
So-
is
so
worse.
We can't.
I mean, 1540
in
was
some
sold for
places-
300 and some odd dollars.
Look at
a
London.
foot.
There are trades taking place
I'm talking about the United
today
States
in
now.
London. Right, but I'm saying
We're looking here. We're talking about our market.
Okay.
And you know, in 2002, you said there was a potential light at the end of the tunnel. You're saying right now you don't see a light at the end
Well,
of the tunnel.
I'm not sure I would say
No,
that.
no, I don't think
I
anyone's
think there
really
is a
saying
light at the end of the tunnel. I just think the tunnel's long, and we haven't driven far enough into the tunnel to see the light.
Okay,
I
so
don't
we
think there's
have to
anybody-
have the pneumatic
I
drill
don't-
push it a little
I
further.
don't believe there's anybody that doesn't believe New York will eventually become a strong market. But definitionally, if that's a word, I'm not sure that we have the right to expect that we're going to have $100 rents again. I mean, nobody's made that a mandate.
I'm not sure we need that to
Well,
create a healthy marketplace.
But I'm going to
I
disagree
mean,
with you
that's-
just a little bit. I mean, under the assumption, and I happen to think New York as diversity is terrific. I happen to think while these investment banks have essentially disappeared in name, they're still in business with the banks that acquired them. And I was
Absolutely.
recently with Bank of America and some Merrill people at a advisory board that I'm involved in, and they're beginning to think about growth again. It's going to happen again. I mean, you know, maybe they'll move 1 million feet out, or they'll have one more monster layoff, but eventually they're going to grow again. They're going to come back, and we're not having any product added. I mean, except for one building on 42nd
Let's
Street.
not forget that.
No new product.
There's no new
And
product that
eventually,
has
I'm
been.
not saying that it's next year or the year after, but I think $100 rents are possible again.
Sure.
What about Lower Manhattan? I mean,
Lower
there's
Manhattan, we
this
see
mix-
articles about how it's only 8% vacant and it's one of the best ones. Because that's the moment in time. It's going to have the same.
It's also
it's going to have
direct
the same
space,
problems
not
as New York.
availability, right?
Right.
When you take into account downtown's entire availability, you're at 15 or 16%.
Yeah, and when Goldman moves out,
and there's
there's
some
gonna be a
challenges.
bunch of other
There's some
stuff.
challenges there.
We talked about downtown before, and I just want to repeat what I said to you off air, and that is there was a time when the downtown was starting to strengthen, and the Class B and C buildings were you could buy them for $100 a foot, put 100 into them. Residential rentals at $38 a foot, and that was very healthy for downtown because it consolidated the better office buildings to a smaller market and got rid of a lot of the tertiary buildings. That has to happen again, and unfortunately,
But we also said when we were getting together before, at that time there was something called the 421G, which provided an abatement, a full abatement of taxes, and there were different cases.
Yeah, but Michael, the market then was $38 a foot for residential rents downtown. You can get even today in an unhealthy market more than $38 a foot. I believe.
That's correct.
So I think you have to price adjust for that. My point is that at some number, these Class B and C buildings can get taken out of the office rolls, create
Converted to
more
some
residential
alternative
housing,
use.
more of a community. It doesn't have to be a 100 million square foot market.
Well, when has downtown
But the
not been
residential-
driven by Midtown? That dynamic.
Well, but I think it changed a little bit, Bruce, if I might. We had about 65 tenants that moved downtown, and it was some of it was because of the spread between downtown and midtown, but some of it was because downtown had become a city within a city with
Attractive
24 hours of and food and shopping and transportation was excellent. The Fulton Street station was promised, and Calatrava, and the path, the new path. I mean, all of that has been delayed.
And some of that
obviously.
will continue.
But that'll happen again.
Yeah.
And I think downtown will have its own growth from within and other tenants moving down because I think it's
But I think service
viable
companies
alternative.
are going to continue to look at downtown, both economically and, to your point, quality of life, as an attractive economic alternative.
As long as the political landscape of New York allows it to happen.
Yes. Yes. But Jimmy, why wouldn't that be the case?
Because depending on how you view the world, whether the budget cuts lead to more crime, whether the taxation becomes too high for people to live here. We had this flight once before.
That's not just a downtown issue, right? When you talk about
No, it's not,
budget
but it's
cuts
exacerbated
and
downtown.
tax issues,
It's
that's a New York issue.
It's exacerbated downtown because it's dependent on the financial services business. And don't forget, you can go to New Jersey and build a building for the cost of the savings on the payroll tax. So what I'm saying is, we still have to compete with factors outside New York for us.
But I think you've brought up a broader
I have to-
macro point, really.
But no, I have to agree with him. It's not such a macro. Ed Gordon, when he was alive, for those of you who are watching and don't know, he was kind of an icon of our industry. He died in 2000. I can't believe it's 9 years already. He used to say there are cycles in real estate and business in general, but there's also a quality of life cycle for a city, and they can last 20 or 25 years and would take something impacting. What Jimmy just said is right on point with what I worry about. Increase in crime, dirty streets again.
Sure.
When I used to look over your shoulder when you walked home at night from a movie and whenever, in the
there
early
was an article in the
90s.
newspaper
Don't do that
saying
now.
that the number of knifings are up.
Well, that's what I'm saying. That can. We saw the flight of all the
But guys,
industrial companies.
every major gateway city and every major city, metropolis, CBD in the United States is facing the same challenges, right? Everybody's operating with a budget deficit. Everybody's trying to move the issues along. It's exacerbated in New York by an already high tax base and a premium that tenants have to pay to be here. So we do have to be, I'm agreeing with you, Jimmy, to the point that we have to be very careful not to cross that line. It's a very fine line.
Nobody's moving to New
And
York because it's cheap.
no question.
So we have to have everything
There's
else.
a premium. We've got to have all the other issues
And
and
what
the other
happened for
issues.
years, I would sit there and nobody wanted their kids to move here, and if they graduated to go somewhere else, companies were not able to attract competent personnel, and that's why some of them fled, as well as the cost of doing business here. And truthfully, for the last 10 years, I get calls all the time. Can you help my son or daughter find an apartment? They want to live in New York. They've got a job waiting, and blah, 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 blah. I mean, constant. Now, that's perhaps slowing down a little bit, although my son's graduating shortly, and he's moving here with 2 kids from Michigan.
Don't forget, from 1974 to 1991, which I call the bottom of the last 2 cycles before this, was 17 years.
That's
It didn't happen in 5 or 4 or 3. So I'm not sure.
I don't know
Even
if we'll be doing the show in 17 years from now.
I hope so.
We'll
I
be
hope
doing
so,
it up
too.
on Mars or something. But I just think it's important to set your horizons in a realistic proportion. We may bottom out in this market by the end of the year, depending on the amount of sublease space eventually comes in the market. But there's no guarantee that means the next year, all of a sudden, we're going to go up 30%. Because the dramatic turn down
I think that's
is
the
the same as the upturn.
I mean, I heard Steve Siegel saying that he sees rents going back to
Yeah, but not
$100 a
next
foot.
year. I think it'll take a lot longer to absorb what's on the marketplace. I don't see it in a year.
But now we're talking
But
about the hockey
ultimately,
stick
you'll
theory
grow rents
versus
again.
whether we'll get a bounce. I don't think anybody here feels that or is prepared to say we're going to see a quick recovery, right? The
No.
type of bounces
I think you'll
that
see
perhaps we've seen.
$75 oil
But-
prices before you'll see $100 rents.
I mean, I was
you know,
reading, I'm not sure if it was your statistics. I
more
was doing some research today on Fairfield County. Greenwich, the vacancy is up. Stanford, the vacancy is up. I mean, it's hitting the entire region. Now, what effect is, as you say, lower
And I can tell
payroll
you, New
taxes?
Jersey's been dead in the water for the last 18 months to 2 years.
So next week when I do the New Jersey show, I shouldn't expect too many
don't think they'll be
optimistic
optimistic.
point of views over there. But So where are tenants taking space when they are taking space? How long is it taking how long does it take for a tenant to make a decision to pull a trigger today? How is the possession? We were talking before the show that certain landlords were, as one would proverbially say, dropping their pants to get a tenant a couple of months ago. Where is the market now in May of 2009?
The market is predominantly renewals, people staying in place, not wanting to spend capital.
Extended blends.
Doing extended blends, that means when they have 3 or 4 years or whatever left on their lease, they do something with a little bit now and do a little cheaper later, and they get a full 10 years added on. That's really the market. They don't have to spend $100, $125, or $150 over a work letter to build the space, and that's, I'd say, the primary market. Now, there's still tenants that move because they have to. They've outgrown their space. They're going to move because they have to. We may have to in a couple of years unless we can do something rational with our landlord.
But I think the landlord's ability to rent at market is a trailing index to the ability to refinance or non-refinance the debt. You have special services today that don't have the total flexibility to modify loans. They're trying to change the REMIC rules to allow for that. And we have $400 billion in loans coming due for refinancing the next year and the year after. 50% is CMBS. There's no CMBS market. So,
and you have to go back to the special servicer if you want a loan modification.
And they won't talk to you.
And it's unclear, Jimmy, to your point, whether the TALF funds, how they'll function, and whether they'll be able to bridge the gap.
Right now, they're purely talking about AAA securities.
Yeah.
But the point I'm making, though, is that there are many borrowers out there that if they can't refinance their debt, they can't make market deals on the leases. I think Stephen's right. I think that you have renewals because there are a lot of tenants that have to do something, so they're going to renew, and they don't want to spend the capital or can't spend the capital. And a lot of the landlords don't have it anymore to give them.
So my question is, so if they're renewing, are they renewing at lower rents? Are they getting the 20% discount or the 30% discount to stay in the space?
Let's put it this way. We have one deal we're working now, which is the lease expires in 2013. They're going to renew not lower than what they're paying now, but they're going to renew at probably half of what they would have had to renew at.
But let's not forget there's a very strong component part of this industry base that in the REIT world, these folks that have traditionally been under-leveraged are able to do market deals. So, yes, there's a segment of the market that doesn't have the capacity to do market deals, and there's a significant component part of this market that can and are doing market-driven deals because their FFO is critical to them. They are realistic about where the current market is. There are far more renewals than relocations. I think we would probably all agree to that. But there are relocations occurring where tenants are right-sizing, downsizing, becoming more efficient. By the way, this is not new news. This has been going on for the last 5 years. People have been taking space as efficiently as possible.
And with regard to my question of what's the difference between the bid and ask, what do you see that today?
I think that's depending on the landlord, Mike.
I think that's
well, I'll give you one example.
It's almost building by building to some degree.
I'll give you an example. We had a lease signed subject to an overseas approval at a building downtown. I'll leave the building unnamed. And it was a fairly competitive deal, and the reason this tenant was moving from Midtown to downtown is they had a $110 proposal from their landlord. 30 days before they were to go for the approval, and they had some hard money up if they didn't go forward with the deal. This landlord dropped from $110 to $60 a square foot, and they stayed Midtown. They didn't want to move. They didn't have to spend any capital.
But I'm going to give you another example.
But this landlord could afford it because it wasn't over leveraged.
There's a building that is owned by a REIT with an equity player, a real estate investment fund, who's on Fifth Avenue. They had a tenant who had 60,000 square feet. They planned that they thought they were going to renew their space. They moved from the 60,000 square foot building in the 42nd Street corridor to Grand Central. They were going to get 60. They moved for $30 a foot. They're moving into a space for $30 a foot.
It's really a mistake to paint all buildings and all developers with the same brush, especially today. Because first you have...
But that's a story, Bruce is talking. The REIT has a greater opportunity.
You can't ask what the bid and ask is because, for instance, there are some developers that are backed by equity players who will ultimately make a cheaper deal than the developer wanted to if they squeeze them down.
Right.
You have lenders who have certain benchmarks, they won't allow the developer to make deals. Every deal is different in New York, and I think that to focus on the bid-ask is the wrong metric. I think you need to focus on what rent they are capable of making a deal at, and still not getting burned down
directly to
burned down
the underwriting of
but
the
more
asset,
important,
to your point, Jimmy.
What the landlord is capable of accepting based on the debt service, based on
the underwriting.
Can I tell you something? My opinion, which is, these guys will probably disagree with me,
They've always disagreed
if
with
many of the
That's
landlords that are out there said no to some of the deals that were proposed, just said no, based on the amount of space that was available and the options, people who are going for direct space as opposed to sublet opportunities that were cheaper, and some of these companies would go very low to just get it off their books. If someone had said no, it was almost a run on the bank by the landlords. And dropping to numbers, I mean, S.L. Green, not to offend them, had a headline in one of the newspapers, "Nobody gets out." Well, with advertising, if you want to stay in our buildings, you're going to get anything you
Wasn't
need.
Charles Cohn offering the same deal? But if you want to live with Charles Cohn,
people are going to go to Green's buildings. Sorry, can you take that out of the day?
See, it's funny you said you thought we'd disagree. I do disagree, but for fundamentally different reasons. I think it goes back to what Jimmy said before. Every building today operates almost independently of the other. Now you have portfolios. We discussed how REITs were generally speaking under leveraged, and so they have capacity to do deals to meet the current market.
They're not under leveraged relative to the
today.
market
They're not,
cap.
but not any longer. But they have capacity and ability to meet the current market standards, whatever or rents, whatever they may be. Many of them.
7.5 years
but my
ago,
point is different. I think
we had an hour. We don't have an hour.
To your question, the
Last
gap
comment.
has narrowed between the bid and the ask.
Okay.
I think landlords want to be realistic.
So on our reunion show of having the kids back, I'd like to thank Steve Siegel, Jim Kuhn, and Bruce Mosler.
Are we over?
We're over. No.
I was going to give you the best line of all.
Okay, what's the best line?
Kirk Kerkorian, when they asked him what did he think of the economy and some of the losses he had, he said, "I lived 1 year too long." And he's 90-some odd years old. I thought it was the greatest line. I said it all.
Okay, see you next week.
Major funding for these programs is provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Cushman and Wakefield, Greenberg Traurig, LLP, New York Community Bank, Bank of America, Kilroy Metal Products, New York's Window Company. Additional funding is provided by Akron Gold Brothers, LLC, Briarwood Organization, C.B. Richard Ellis, City Investment Fund, Essex Capital Partners, Excel Realty Advisors, First American Title Insurance Company of New York, First Service Williams, Gemini Real Estate Advisors, Hal Fettner, Durst Fettner Residential, Helmsley Spear, James D. Kuhn Real Estate Institute at Syracuse University, James Orphanides, Massey Knackle Realty Services, Madison Realty Capital, M&T Bank, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Group.